IBM lost almost a quarter of its value overnight. In the same session, Wall Street cheered the coolest inflation report in years. Two headlines, complete opposite reactions, and by the end of today you're going to understand exactly why both of them matter for your money. Let's get straight into the numbers. The S&P 500 closed up 0.38%, finishing at 7,543. That's its best close in almost a week. The Nasdaq Composite did even better, climbing 0.9% to just over 26,100, as semiconductor stocks staged a sharp comeback from Monday's sell-off. The Dow Jones Industrial Average barely moved, up less than 10 points, essentially flat. That headline number is hiding a much bigger story we'll get to in a moment. Small caps were roughly flat too, with the Russell 2000 basically treading water. Volatility eased. The VIX dropped to around 16.5, down from Monday's spike above 17, a sign that some of the panic from the Iran headlines has drained out of the market, at least for now. Bonds told a different story. The 10-year Treasury yield held near 4.6%, close to its highest level in almost 2 months. Gold was roughly flat around $4,010 an ounce. Oil stayed elevated near $80 a barrel. And Bitcoin drifted lower, sitting around $62,000. So what actually happened? 4 things drove this session, and the order matters. First, inflation surprised to the downside. The June Consumer Price Index report showed prices fell 0.4% for the month, way more than expected, and annual inflation cooled to 3.5%. Economists had penciled in a much smaller drop. This is a big deal because for weeks the market had been bracing for the Federal Reserve to raise rates again this year. A cooler inflation print takes some of that pressure off, and it's the single biggest reason tech and semiconductor stocks roared back today after Monday's beating. Second, the big banks kicked off earnings season, and the results were genuinely strong. JP Morgan posted its best profit quarter ever. Bank of America and Wells Fargo both beat expectations too. Normally that's a green light for bank stocks to rally hard. Instead, the reaction was muted. Why does that matter? Because it tells you the market is more focused on where interest rates are heading than on how much money the banks made last quarter. That's a subtle but important signal about what's really driving sentiment right now. Third, and this is the story of the day, IBM collapsed. The stock lost close to a quarter of its value after warning that profits will come in well below expectations. The company said big enterprise clients are shifting spending away from traditional software and hardware and pouring it into AI infrastructure instead. One stock, one warning, and it was heavy enough to single-handedly cap the entire Dow's gain for the day. Fourth, the geopolitical backdrop hasn't gone away. Oil stayed elevated near $80 a barrel as tension over the Strait of Hormuz continues to simmer, keeping a floor under energy prices and a low hum of risk in the background of every trade today. Now let's look at where the money actually moved. Semiconductors were the clear winner. The chip sector, which got hammered on Monday, bounced back hard, with the semiconductor ETF jumping 2.5%. That cooler inflation print gave growth stocks room to breathe again. Energy stayed firm, riding that elevated oil price. It's been one of the steadiest sectors all week. Technology services and legacy hardware were the weak spot, dragged down almost entirely by IBM's warning, which is a reminder that one bad print in a heavyweight name can distort an entire sector's red for the day. Financials were mixed. Strong earnings, but a lukewarm market reaction, which tells you investors are more worried about the path of interest rates than they are excited about last quarter's profits. Here's the rotation signal to watch. This looks like a buy the dip in growth day, paired with real caution on anything sensitive to interest rates. That combination, cooling inflation but still elevated yields, is going to keep whipsawing sentiment until the market gets more clarity from the Fed. Now, here's what actually matters if you're trading or investing on the ASX this morning. First, the open. With the S&P and Nasdaq both higher and volatility easing, expect the ASX 200 to open flat to slightly higher. We're not talking about a big gap, more like a gentle lean upward, with tech and energy doing the heavy lifting while the banks stay subdued. Second, sector spotlight. Keep your eyes on ASX tech names like WiseTech, Xero, and Seek. The semiconductor rebound overnight and that stronger Nasdaq close tend to flow straight through to ASX tech sentiment, since these names often trade as a local proxy for what happened on the Nasdaq the night before. Energy is the other one to watch. Woodside, Santos, and Beach Energy should stay supported as long as oil holds near $80 a barrel on that ongoing Strait of Hormuz risk. Third, the commodity red. Oil is your strongest signal this morning, elevated and sticky, which is bullish for the energy majors. Gold was roughly flat overnight, pressured by firmer yields and a stronger US dollar, so don't expect much of a move there for Newmont, Evolution, or Northern Star today. Iron ore didn't get a specific overnight catalyst, so BHP, Rio Tinto, and Fortescue are more likely to trade on broad market sentiment than on any fresh commodity news. Fourth, the Aussie dollar. The US dollar index firmed up overnight, which points to a softer Australian dollar this morning. That's a mild tailwind if you hold exporters or miners that price their earnings in US dollars, and a slight headwind for anything that imports heavily or relies on domestic consumer spending. Fifth, and this is your one stock to watch today, Woodside. You've got a sustained oil risk premium from the Middle East and a firmer US dollar working together, and that combination makes energy the cleanest, most directly tradable overnight read-through into this morning's open. If Iran headlines escalate further during our session, energy names are where you'll see it first. 3 things to keep on your radar during today's session. 1. Watch how ASX Tech opens and holds. If WiseTech, Xero, and Seek open higher and hold those gains through the first half hour, that confirms the semiconductor rebound story is translating locally. If they open higher and fade fast, that's a sign local investors aren't buying the relief rally. 2. Watch oil-sensitive energy names for any follow-through. A steady grind higher in Woodside and Santos would confirm the market is still pricing in real Hormuz risk. A sharp reversal lower would suggest traders think the worst of the tension has already been priced in. 3. Keep an eye on bond-sensitive sectors like property and consumer discretionary. With the US 10-year yield sitting near 2-month highs, any weakness in Goodman Group or Center Group today would tell you local rate fears are creeping back in, even after that cooler American inflation print. If this saved you some time before the market opened, hit subscribe and turn on that notification bell, so you've got this waiting for you every single morning before 10 a.m. Are you buying this dip in tech, or are you staying cautious until the Fed gives more clarity? Drop it in the comments. I read every one. See you tomorrow.